subscribe, like, and share these videos. Sorry about last night, folks. I had some complications come up that I could not show up, but I'm here tonight. So in tonight's video, we're going to talk about this employment report and what's going on here. I'm starting to get very sketchy about the government reports anymore. Let's get into tonight's video. Welcome, everyone. I want to talk about something that happened today, and I've been going on about this, actually going all the way back to when the big, right before the election, when they adjusted by 800,000 jobs, almost 1 million jobs. Well, they pulled somewhat of another snafu today. They got this big number, depending on what you look at, 130, 172 new jobs today. And markets reacted, but they started to sell off because I think they were feeling what I was feeling, is that like nobody was talking about the revision for 2025. And that was a big takeaway. And it was like, okay, this month is fine. We'll just ignore all the jobs that they just kind of rewrote what they were. I think it turns out to be like 15 million jobs a month instead of like, let me see, I think I do have something here to address these numbers real quick. So bear with me while the room's starting to fill up anyway. So headline number was revised downward by 898. And I always wonder, and I've talked about this for many years, these seasonal adjustments, why are they necessary? Why don't you just tell us what the number is and let us figure out what we want to do with it? Why do we need seasonally adjusted numbers? I've been arguing this for many years. This whole thing has been sketched from I actually I had to do a talk my second year in the business in front of a group, and I brought it up, what government reports can we trust? And there weren't very many, because that word, seasonally adjusted, is something else. So the end, so it's just down. So 2025 was revised from 584,000 just to 181,000. If you spread that across the months, it's 1.46 million added in 24. That works out roughly 15,000 jobs, 15,000 per year, per month. So, but no one reacted. I mean, market should have plummeted. Last night in my Substack, I said, I think we're coming into a surprise. I think they even showed us the numbers for October, which were negative, which we kind of knew, right? That they weren't telling us. So I'm just really concerned about the integrity of everything that we're dealing with anymore. It gets more and more frustrating every day hanging around the markets. And I know, I did this viral tweet that I got about 5 million views on, and all the Bitcoiners woke up to a new world as well. They found out they've been, basically gaslit, that the scarcity thing, well, it's there in the coins. They were able to create all this synthetic coins. And I know this is going to sound a little cocky, but I think that tweet that got out to 5 million people, and I looked at some of the people that were viewing this, and they were some substantial influencers and other folks. We'll leave it at that. And now I watched a guy interviewed on Bloomberg the other day, and it was like a direct quote from my tweet. And as always, I have this problem, TLDR, too long didn't read. I tried to shorten up the newsletter last night, but I think so I'll talk about that at some stage, but I want to stay on this thing. But everybody's being lit up by this or, misled is maybe a better word, by all of these things that are going on from the standpoint of these market metrics. The Bitcoin people woke up and realized that their greed to get somebody to pay a higher price than $125,000 was to get ETFs and retails. Listen, I spent a lot of years on trading floors, and where used to always yell, "Don't be the bag man." Well, they were looking for a bag man. Instead, what they did, and I warned everybody, you guys know that have been around, that the whole Bitcoin thing was being diluted. And once you bring in the Wall Street guys, you bring in all the wrong people you want hanging around your asset class. And you can look at when you financialize an asset class and you bring these guys in, they know how to work the numbers, how to work the markets, and then you get what you got, right? It was all about greed, and you didn't care who you brought in the door, as long as you thought they were willing to pay more than the last guy. And in fact, what they did is what they always do. They came in and they destroyed, they became the price discovery mechanism around the markets. And I still see people arguing that the spot marginal buyers in the spot coin is where the pricing comes from. And it doesn't. If it did, it wouldn't be in the 60s. So, but it's really just this kind of thing that the Wall Street guys are just running us around. I mean, it's near criminal. I will say that. And then you get the government throwing out these crap reports like this. I mean, seriously. I've been around a long time, and I never. The folks that have been around this channel for a while, I've been talking about this stuff for years, and it really clicked on the update when we got the numbers adjusted right before the election by Biden. And even all of the numbers were being pumped by opening up the border and using new bodies and new jobs. They were pumping everything. Nothing that we've been trading off of for I don't know how many years. It didn't even feel this bad after the pandemic, actually. It felt like it normalized again. But everything we've been told, everything that we've been trading off of is just not, it's just not there. It seems to all be just gaslighting everywhere. Okay, so let's talk a little bit about that. I'm sorry to get on these things, but it just, we wait for the employment numbers and they give us this piece of what, and it's just sad. I think every agency. I mean, I saw somebody talking about, I don't know if you saw the Boomer Esiason thing on how much Darnold paid $250,000 in taxes because he was working in California for 9 days or something during the Super Bowl. I mean, it's just stuff like that. I mean, it's really hard to believe in the system, and especially for a guy like me that's been around, since 1979, and I've seen a little bit of everything. Literally the collapse of Japan in '89, and just go everything that I've been through. Most of the stuff I've been through, you folks, some of you are my peers, I know that, but most of you read about the stuff I lived through while being a market participant and on an institutional level. You mean on the trading floor, institutional desk, and big, large trading desk, and it boggles my mind. And then it boggles my mind, especially, and this is not an attack, but unfortunately, all the people involved in Bitcoin have been told a lie too. And it didn't start off as a lie, but it became one when the asset got financialized. And that's all there is to it. That's why I did this big tweet. And if you read the follow-up tweets that I was doing during the viral moment, we'll say, I tried to engage a lot of people. There's some really good stuff that got flushed out there. And I'm glad I was the one to uh, at least capture that moment. And so, let's move on. Let's go on to the markets. So market reaction, somewhat positive, and then it faded during the day. And I'll show you some charts in a moment. I mean, this market is got to be the worst. And one of the things I talked about in the Substack newsletter last night was just that I think this is just becoming a monster distribution. And I'll put this out here for a minute, is that one of the best places to learn technical analysis or learn about market action is to put a 1 minute chart up and just look at bars. And I saw a pattern today. I don't believe in looking in the rearview mirror and look what it did in 1983. It looks just like that's crap. The people that were trading, the market psychology and the pricing mechanisms that were around in 1983 have nothing to do with 2026. And I see those things, and it looks like 1929. Don't do that. Trading in a rear view mirror is a really bad habit, and because that's where you make most of your mistakes, thinking it's going to repeat itself, and very seldom do those patterns. Now, more recent patterns that fall in the market, I could do a whole presentation on that, but looking back too many years, that's stupid. I'll just say it. Maybe we'll use the word ignorant, so I'm not attacking people. But that stuff just doesn't work, and there's no point in looking at it. But if you're looking in like a big pattern that happened, you'll get it's still burned in people's mind that's a good look back. Short term, look back 2 blocks, if you will, on the street in the rearview mirror. If you get too far back, then the relevance becomes less and less. And anybody that's looked at those patterns found out they didn't do that this time. So what I want to point out here, and we'll get into all the markets tonight, I'm just going to go right through everything as fast as I can. I'll try to cover things as directly as I can. And there's some interesting patterns out there developing. And it's the same pattern, unfortunately, like S&P, NASDAQ, that I've been talking about since virtually last October. So it's been a while. But I think this thing is going to resolve itself. I got all built up. We're still in that window of the 11th to the 13th, that window. And I'll show you on the algos what's showing up. It still looks generally positive, though. And I said that the other day, is that even this date, there's a positive kind of tone behind this thing that I'm seeing. So anyway, I'm just looking at something here I want to read to you because it goes along with what I'm saying. So there was a methodology change going forward. BOS changed the birth-death model to incorporate current sample information each month. That's good. What I've been arguing about, they need more current, stop looking backwards, and we need some forward-looking metrics as well that we're extrapolating out maybe a trend, almost like the algos do, because looking in that actually goes to exactly what I'm saying. Not only on government statistics, trying to trade off those past patterns and all that. I've never, not that maybe somebody gets a benefit from it, but it sounds good. You have to realize most of the investing public, which I'll tell you, the one thing I learned from that the viral thread was virtually nobody understands market mechanics. It's sort of like, I guess the Zoomers can't even write in cursive. Or they've only used, a calculator. They've never done longhand, and you need to understand the mechanics. I had a conversation with somebody I know quite well, and they had no clue of what the mechanics are. And they were arguing ideology, not mechanics. And I think that's why that tweet it kind of hit home with a lot of people. But the methodology change, that's good, which should help the reduce the size of future annual revisions. So I don't know if Scott Bessett's in there talking to these folks or what's going on, but I'm glad I read this thing. I actually just went into Claude and asked it to explain what happened today. So I'm reading off Claude over here, and yeah, you can see this. This is so I just said what was 2025 report adjustment. So that's it. So wrong button. Sorry about that. So anyway, I think I've unwound that. I know I spent a lot of time on it. We're full in the room, so let's get into the analysis. And I'm working on a tweet. I'm going to do a thread on something. The other thing, just back to Bitcoin for a moment, is the other thing is everybody's calling to pull your coins off the exchange, put them in cold storage. I'm going to address that issue. It's not as cut and dry as, once again, people are being told. So what you have is a group of people that are not very knowledgeable on market mechanics and don't understand the uses and the necessities to have a float, a very active float, and it needs to be to a certain size to be affected. So let's go ahead. Let me bring up some other screens here and we'll get into tonight. All right. So here's a database. We're back up to 52%. So we basically got a positive day in the market. So we're seeing some flow coming back in. We had roughly about 600 new buys in the database and maybe 130 sells, 140. So we had a positive ratio. You can see both over here where it says sentiment, it says bullish right here where my cursor is. So we got a bullish rotation. That's good. We moved up to 52.74%. We look down at one of the things that I've been talking about here is that these are all sectors and buys, and these are custom sectors that we run. So we're looking at a bunch of sectors right now. I think there's 5 material ones that are in their holding period and they're exceeding. So even they've exceeded their normal holding period, doesn't mean they're going to get sold right away, but it does put them at we'll say at-risk sectors that are coming out here. And let me go off screen so we can all see this. So basic materials, metals, it's extended. There's a big one down here, which is 65 days, 65 of 30. So it's double its holding period, which is transportation. And then we've got energy, medium, not quite long in the tooth. But what this means from us as investors and watching the equity markets is tells us they're pretty highly invested for short term. This thing changes every 30, 45. There's about a 35 to 50 day cycle, and it will rotate the sectors. It's very dynamic and gives you a pretty good feel about the short-term markets. But when you go over to the weekly, this is very solid, and it doesn't bounce around much. And the numbers here, the holding period. So the holding periods on daily are like 35 to 50, rough numbers. This is closer to 160 to 220, maybe 240 days, as these are intermediate weekly charts. You are able to detect more material rotation in the database and the market and see where concentrated bets. And when you start to get long in the tooth here, then it's much more significant. and we're seeing some of that. As I've said before, I just want to stay on the database for another minute, is what it's going to get us is it's actually going to get some longevity and holding and the underlying trends, okay? So let's go over to the E-minis now. And this is where I've been talking. I'm going to show you a weekly chart. Most of what I'm going to talk about in the S&P will also apply to the NASDAQ. It's a little bit different, but not a lot. But this pattern right here will go from November, but it really extends all the way out here into the end of October. We've had one big spike down here. This was another tariff mania. I think this was when the stuff was going on with Canada, and it looks like the House has just passed a bill to challenge Trump on his tariffs on Canada. So, yeah, so we get a lot of noise in Washington. But this is what I'm talking about. And I saw a similar pattern literally on the 1 minute chart. And I was going, okay, what happens? What's the possibilities here in the market? But look at the algos. We got a little spike here on Friday the 20th being projected. It's probably an aberration. It probably has something to do with one of the spikes back here. And what happens with these algos, they'll echo. So it's got a 150-day look back period right now, and it'll find those little spikes. And those are usually will smooth out as we get closer to it. It'll even mitigate down to zero or just stay sideways. And this is, I mean, we are flat. Look at the moving averages projections in the future. That's these dotted lines. There's 3 moving averages that are being projected to be the same value. But that's not how it's going to be. But that value right there, around 69.55 on the E-minis, is going to be a big pivot. So chances are it's going to get within a market grid, these orange lines. You guys should get those on the Substack, kendallreport.substack.com. It's $8 a month. You'll get that indication all along. I'll have to check it, but I did run the data sheet as well, so we can see what the data sheet's doing with this. But we're flatlined. I mean, this is like the worst nightmare, except for if you're a day trader, you pretty much can count on the market grid kind of coming in. But let me just zoom in on this thing right now. So look at the market grid. It's collapsing in as well. And what this tells you is the daily range volatility is collapsing. And I've told you before, when it gets really narrow, then that's at the point when we start to get some sort of pivot out of that area. And when that pivot happens, then we'll get a signal for the next direction. And I remember even going back here not that many days ago, we were getting these red lines down here, Fibonacci targets. We were getting Fibonacci targets. We went right in there. This was that big Friday reverse. And we got in right into, I think, an S3 daily. And it just bounced out of there. We had the fib targets down there. Meanwhile, if I bring up the indicators here, that was where there was, let's see if I can get right to the exact point. So that was the day before, is where we were signaling the V bottom. And the V bottom was perfect to locate that reversal. And right now it's in a solid line because it happened, but at the time it was little dots being forecast that the indicators were going to jump up, and it did it on multiple levels. I think PPN 1, 2, and 3. When you get 3 or more, it's a really strong signal. So next day we opened unchanged, went a little lower in the previous day, and big time reversal. And I believe it was an S3. I know there's folks on here. I remember seeing folks reporting this trade that they caught on Discord, so on our Discord. So that's a good thing. But when you start to look at this, it's the same way. So let me go to weekly real quick. Then we'll do NASDAQ, and we'll start accelerating, getting through all these markets. So this is sort of interesting. The red dots, these red dots are forecasting closes going forward. And it looks like we're going to trade back up into the upper end of the market grid. So on the short term, we're contracting around it. On the intermediate term, I'm going to break this down, especially with those that have the indicators, so you can kind of put this stack together and how they're talking to each other. So short term is consolidating, suggesting that we're coming into a move because the value of each day's range is collapsing. That when it'll stay there for 2 or 3 days and then it'll explode out of here. I would argue that, and there's underlying on the daily suggesting that's going to happen. The red dots here on the weekly is suggesting we've got an upward range, and I'll just give you a rough number that we're going to run back to into the 71 handle. Okay, so we've been playing around here, low 70s, mid 69. So it looks like we've got a shot coming in. Let me zoom out here just a little bit. Coming into around 23rd of February, so another 10, 11 days from here, that we're going to have that underlying bias. So there's no collapse coming. You know, like I said, I think if you looked at the unemployment data, that was a really bad report because of all the revisions. What they revealed today, it seemed like everybody's went, okay, that happened. So literally, like I said at my beginning comments, everything we're trading off of was not real, okay? We were trading off 584,000 new jobs, not 187, right? So they changed the whole picture and the whole contrast there. So let's break this in, and you see a little bit of upside on this, but nothing big. I do want to say just one more thing here, is if you notice the slope here, the slope and the angle, the dots are projected there. These are not real, okay? What they're saying is this is the projection based on the algorithms maintaining. I've talked about this trend maintenance. When the indicators get like this, especially on a weekly, just tells you there's a steady trend. It's staying over levels at 0.31 or greater. 0.25 is the trend. And you can see in the projections in the future, it's projecting that slope of those moving averages are going to keep going up. And I've told you before, if you see anything that looks like SMA 21 on a weekly, that's your buy your dip point. And you know, so we'll see how this all plays out. But it looks like we've got, like I said, we still had that window 11 to 13. So that's into Friday, right? So Friday's Friday the 13th. But anyway, let's move on. We'll start top down here. Yeah, we'll start top down. So NASDAQ has kind of a flat, then an uptrend being forecasted. We got pretty close. I talked about this 40-period moving average from the standpoint of that being on the S&P weekly 21-period moving average by the dip. On the NASDAQ, it's the 40-week average, 24,029. Hang on, not the right value. 24,158, so call it 24,160. If you saw that number, you'd be a buyer. I don't think you see it today, but the indices, I have my trading screen up on top here, and it is, we're seeing a little bit of buying back in. It did go negative a little bit, so there's still that underlying tone. That's my point. NASDAQ, a little different configuration. Maybe because of what's going on with the tech stocks and some of the rotation distribution that's going on there, but still basically flat. The ceiling up here right now is around 25,500. We're doing round numbers. If we go down to the daily, you'll see a little bit below the moving averages, but still basically still flat. Okay. And I see somebody on the timeline, a 10% correction is coming. Nah, not yet, but it probably is. That distribution pattern still has a way to play out. And if you look at the year-to-date numbers, you'll see today the mid-cap took over the Russell, and then I think then it's S&P and NASDAQ if you look at those four. And all that's telling you is, I've always argued the mid-caps have better profile or better fundamental profile than the small caps do. And until we get the yield curve where I'm talking about, when that happens, then the small caps are going to rule. And we're probably seeing a bit of inversion. I would expect that we're almost there now, is that we start to get double-digit returns. And this overall trend, all equity indexes are going to have an underlying bid probably till June or July. So I don't think a 10%er here, that's a big move. I don't see that happening. Anything's possible. Hopefully we'll get a detection here, and at least coming in right now on the algos where I just moved the cursor, that's February. This is daily. Let me go back to weekly for a second because I want to see what potential trends are being forecast out here. Yeah. Maybe a little, this is not the profile where to get the 10% or where these fib targets are down here, that's what you'd have to get to. You'd have to get down to 17,000, maybe a minimum here, 20,000. I don't see that happening at the moment. We'll see, and if it is going to happen, it's going to be closer to June and July. It's just going to grind out. I was hoping there'd be a little bit of reset in mentality, but listen, the Fed funds, because there were 3 drops, which I'm still thinking we get 3 drops in Fed funds just to get the yield curve in position. We'll see when we get a new Fed in there what happens. But the bottom line is there's too many favorable things going on, even though the NASDAQ, there's a bunch of stuff you could argue that are overdone, but the Fed funds have already adjusted to no drop now, just because of this jobs number. And I would argue that it was a really bad jobs number. I didn't see the plus out of them. I still think we head up to about 4.7 in the next quarter or so. So is there potential for weakness? Absolutely. There's some pretty good support levels. We'll just see, like I argue all the time, you can put trades on if they make sense, but I don't know where the market's going to be in 3 to 4 months, but incrementally the market reveals the math that it will give us a pretty good directional set. And right now there's still a lot of primary trends in place. So there's still going to be the buy the dip syndrome. Okay, let's move on. Let's go to metals. We'll get through the rest here pretty quick. Yeah, I'm only half past, so this is good. So gold weekly, let's just blow that up. Look at this angle of attack on gold. And so a couple things that happen. I'm glad I opened this weekly chart up. All right, I can get my drawing tool. I'll be able to do this fairly quick. So if you see that where my cursor is, this is what is going to have to start to happen. This is a weekly gold. See, I'm just going to draw this. So this bar that's sticking up was the big spike the other day. And then what's likely to happen here is that we'll start to see the typical pattern when the market grid blows out and gets, this is what I call volatility bubble. Obviously we had that big spike in gold, and then it collapsed, and now we're holding this 10-week moving average has been the buy point. We'll look at the dailies. That should be very similar to the 40-day moving average on gold. And then what should happen is this. And then inside here, we're going to start to get the market to trade. I'm just making random, but it's going to trade within the collapsing market grid. And once this thing normalizes, this is a weekly chart we're looking at, probably maybe as far out into October or beyond. We could spend the rest of the year. Still have room to trade higher. I think that spike high is going to be the high for a while, and we get this. So it'd be some good trading on the daily stuff, but this is how gold should end up looking. Let's just see if we're going to get some sort of, let's take a look at the algos. Yeah, so algos are saying strong and then some weakness. So that's how it should trade out. And we'll probably stabilize right around 5,000, 4,800, 5,200. What was this spike here? 56.26. Yeah, so we'll stay the high and the low here on last week was 44.43. So 46, 51, just trading randomly in there. The daily chart should give us a pretty good feel on how you're going to be able to trade this. But this is a trading market. If you already hold it and you rode through whatever, you know, I've been literally accumulating down way back here at the 2,400 range, 22. So that's what you should do. Depends on your scale. If you're an intermediate trader, then there's going to be swings in here you're going to be able to take advantage of. You might be able to pull off some straddles and collect a lot of premium out of the options. But this is pretty solid. We'll go to a quick weekly, then we'll do silver, and then Bitcoin. We'll call it quits for today. I'll answer a few questions. So this is perfect that this came up. So what I was just drawing on the weekly, this is what the weekly will end up looking like. And this is interesting. So I just said new highs. We have fib targets on the upside right now. 57.65, 62.78, and 65.95. That's these fib targets. What will negate that if we were to trade? We traded under 46.70. That would negate these numbers up here. But we're getting that this is perfect to explain, is the weekly will have the same mechanism. So when you get the volatility bubble, which we got, you can see it usually takes between 5 and 8 bars. It can take up to 12 to get where we are now. Now we're squeezing into the pattern. Right now, we'll go to the algos next, but right now the fib targets are suggesting breakout to the upside. The weekly chart, that steep trend says upside. So gold's not over, but you'll see when we go to silver, different story, not the same story. I know the silver guys believe in silver, but gold is much more, it's much larger. And, you know, this, I'll just mention because one of the things, The derivatives set the price on the margin. Those are basically replacing the margin. So there's as much as 50 to 100 times paper gold over how much gold is out there in the physical part of things. So just know that this is the patterns that are setting up, right? So let's just play this out a little bit. So algos are showing really, they're not really confirming this upward fib targets, but they're there. We'll respect them as long as they're there. There is a big surge coming, it looks like, or maybe we're going to break out of here. Maybe we retest some of these values. And for those numbers, you'll need to use the weekly charts. Look at the weekly market grid, probably an R2, R3 kind of hit. That'll be your maximum levels. When I wrote that special, and I listen, the guy that does all my work is, he's in India. He's building this new membership site, but he's on vacation this week. Good news, he gets back on the 14th, so soon he'll be back at it. So next week, the plan is to release that algo that I used to write that silver report, which projected the exact range where the exhaustion range was on that parabolic curve. So I'm going to get that stuff out and some other things. I'm building it up while he's all done. So it should be pretty simple. And this is going to be a membership site with no charge on this. You'll be able to get these scripts, and they're scripts for Claude. I don't know what happens if you throw them into GPT or something else, but they're built on Claude. They should probably be used on Claude. I'm going to give them out to you guys for free. And I'm working on finishing this one right now, which will do all the analysis, PPMs, the moving averages, even looks at the future by using a screenshot to figure out how to do some of this stuff. So looking forward to getting that stuff to you guys. But you'll need the indicators, and that's kendallreport.com/indicators, plural. And you can also add indicators 24 if you have any issues with that. I think that glitch has been fixed, but just in case. So, okay, let's go to silver. I'll show you this. When silver got hit, this is a daily, completely different pattern. Does look like we got a surge coming. We did not. I'm going to show you this here. These dots here, we did not get a new Fibonacci projection to the upside, but what we got, when you only get these single dots, that's a pivot area. So your max, if we get up and we run to 111.34, you're going to be on a seller there big time. Usually that'll be, on the run up to that number. We now have what? 5 calculations, so it still could end up to be an island. But looking at the algos, the confirmation, at least PPM 1, shows we've got a chance to challenge the 21-day moving average right now, 91.70. That 90 area is going to be a big wall. But if you look at what I just showed you on the gold chart, we had a consolidation, symmetrical consolidation. This is a bit different. The market's broke. I just want to look at a price here just so I don't misquote. So 70.67 was a key number. Let me see what we printed here. 74 here. Oh, this is the number. So 63 even low. The fact that we were able to trade below this low tells you the probabilities of a new high. It'll change as we get more structured to the market, but the probabilities of a new high right now, like 30% roughly, only because we made that new low in that pattern. So the shape of the pattern still suggests that we need to retrace, retest, and then at that level, we'll be able to figure out whether we're going to make an all-time new high, but completely different pattern. The weekly, I believe, is even more in damage. Yeah. Yeah, this is like, look at the algos on a weekly. They're just all down, and they're down until the longer term ones are down into October, and then we're looking at, we still have this upslope 21, so that's a positive, but these values somewhere in here, like 63 is a point you're going to want to watch there as far as that goes. But completely different pattern. So let's go to Bitcoin. Not good news, folks. I've been talking about this, but we're looking at almost down to the 200 on Bitcoin. 200 value 58,085. We printed 59,930. The issue is I don't know if I can. Let me try something. I've never done this, so this will be new. Perfect. It does work. So here's the deal. This is the indicator on the 200 week. So that was a weekly chart I brought up. 200 week is negative. It looks like it's going to try to make a comeback, but we're looking at, I hate to say it, like Jan 27. When you look at all of these indicators, we're in a super bear market. And I know I have to quote somebody. I was going to do this earlier, but I got to quote you on this. Is just too good. So Jim Chanos, the famous short seller, right? This is a strategy, so maybe I'll bring up strategy too. But the CEO of strategy was on Bloomberg. I didn't get a chance to watch it. I knew he was coming on. But he says that the CEO of strategy says the story of the day is stretch closes at 100, exactly how it was engineered to perform. He says it's at par. So these are their junk bonds. So, but this is what Chano said. I'm still laughing about this comment. He goes, can you imagine any other CEO with a plunging stock saying the story of the day is our junk debt is still trading at par? I mean, I thought when I saw this, I go, maybe Chanos he's the guy that's wanting to take down Mike Saylor. I'm telling you, if they do get liquidated, as soon as the liquidation sale is over or during it, you need to buy Bitcoin. That's when you buy it. But for right now, if you think what we looked at gold earlier. Let me put this back on screen full. Let me get off screen so you can see it. But this is the sad truth about all the trends going all the way out to even. This is weekly. These will change. It's hopefully that this 200 will hold, which is around that 58,000. But the trends are just massively down. And there's not much. We should start to stabilize and bounce off this 10-week moving average. And I'm just going to blow this up and just go to a 1 month. There's not a lot of data here, but this actually holds a little more promise. This 40-month moving average, the crossover is right over here in August of this year, 26. If we're lucky enough to hold that number and we trade between the 40 and the 10, that gives I think there's a possibility of maybe trading back to 90, but it's going to be really, really volatile. Let's go to the daily. Good news on daily. We got some upward. Looks like we have fib targets up here. 76. This is the biggest number on the board right here. I'm blowing this up so you can see this. Let me pull it over. What I want you to see is this red dot, and I'll get the value for you. That's your pivot point, and the fib targets are projecting us to test the 21. This is daily chart we got up, 21, and then the possibility of coming up towards the 40. So let's take a look at what that number is. This pivot number, the magic pivot number is roughly 80,000, we're going to call it. I just want to see if I can find this number on the sheet. Bear with me 1 second while I'm looking at this, okay? It's 81,348. So that's where the top end is likely to start. So, okay, folks. Let me come up and let's look at some of the questions you folks have. All right, let's see what we got going here. Yeah, what's the catalyst to keep the market up? Don't know. At the moment, Iron Trader, I'm just kind of looking through some of these questions here. Sorry, I gotta get close to this thing to get there. Yeah, I believe that's true. The BEAV 30, Adobe probably is going to get replaced. I remember when Adobe owned the internet at one stage, probably about 15 years ago, maybe a little less. Yeah. Listen, there's something wrong with strategy and the way it's running, the way that these guys talk. If any other CEO talked about, and Kathy Wood does this too, okay? She's always talking about, the $1 million Bitcoin and all this and forward pricing stuff that she has no idea. Nobody has any idea where it's going. And I mean, if you look at this strategy chart and put ARK up on there, you'll see that you want to see a chart that looks the same. It looks the same. Sweet Kathy has wasted more investor money than anybody I think that's ever lived. And maybe Saylor will one her up on that. Okay. All right. I'm going to go back away, so we'll do some questions here, folks. Yeah, I appreciate somebody is part of the total level of non-farm employment for March. Yeah. Pretty crazy stuff, I think. All right. just looking through some stuff. Yeah, that's interesting that the healthcare sector switched to accumulate. That means it's getting pretty long in the tooth. Was that daily or weekly? I wonder. Not. So let me just look here. Yeah, that's true, David Ford. The small cap zombies are now leading. Here's the one I saw earlier. Correction is coming 10%. Don't think it in the moment, but hey, somebody pulls the plug, wrong thing said, sure, why not? Yeah, I'm just looking through, folks. Just yeah, I don't know. 8 SMA seems pretty random, but that's okay. I don't use those numbers. Never use 50 or 100. Those are just dividing the 200, which that's fine. Um, yeah, and I wouldn't argue, Todd, that we're heading down to some much lower number, whether it's 30 or not. The trends are pretty bearish, as I showed you. Let me just take a couple more things and then yeah, so let's answer this is a wave tech question, it looks like. Bob, when the daily holding period ends, but the signal is accumulate, should we get a new buy at one point? No, it'll stay in and accumulate or not, or it will go to extended long in the tooth and you'll get out when it gives a sell signal. Now, having said that, that's one of the things that I'm putting in the script for WaveTech when I start releasing those is to address that probability of holding. And so that it'll be a manual. I used to advise against any manual tweaks. You just play the signals all the way out. Well, this is going to help us to give us a little better control, even if you were to sell part of the holdings at some point, just to reduce the risk, because there's always a chance. What will happen, it can go from accumulate, it can come back, it can rotate in a cycle, especially if it's an extended cycle, it can go back and forth from accumulate to, to underperform basically. So, but those are, yeah, I'm addressing that in some of these. Yeah, I don't know if Kathy and Michael are related, but I think maybe, I don't know, does she show that she owns that asset? I'm not sure. Let me look at, yeah, so Andre, good question. I'll try to finish on this. We're right at 1 hour. Uh, will Bitcoin ever come back? I don't know for sure. No one knows that, but it does look like all the trends and the pressure is going to continue on the downside. And I addressed something one night. I remember talking about it, but one of the things that happened is, well, whoever they is convinced a lot of retail investment advisors to buy Bitcoin, and their customers were never suited for that, even though I've heard this from somebody I know that has an account at Charles Schwab under their managed platform. Just put 5% in there. It doesn't, if you lose it all, use it. Let's put it this way. That's the worst advice ever, because think about that, if, especially any of you advisors that are listening, you lose 5% for your customer. I get it's 5% of the portfolio, but let's say everything stayed flat and you lost that 5, no one's going to be happy about that. And I think what happened is a lot of folks that were convinced to buy Bitcoin because now all of a sudden it's legitimate. And like I said early in the context, people didn't know to be adopted meant lower prices. And so they thought more bodies, higher prices. And that's not what they got. They got the opposite. Matter of fact, we dropped virtually 50% of value from 126 down to 59, right? So that is 50%. So people aren't, even if it's one asset. I had a guy that had a management company. We got clocked on Netflix. Go back to like, I don't know, 2009, 10, and Netflix just got tanked one day on earnings. But we lost, it was like a 40 something odd % loss on that asset. But I argued with him, I get that it lost that much, but the allocation was only 2%. So he lost 0.7 roughly. He didn't lose 40%. And the next trade out of the box was a 325% gain on Netflix. So it was out, it got out of that trade, market set a low and just went moonshotted, went into a parabolic curve right after that. So it went from a 50% loss to a 300 and some odd % gain. And so it's your exposure you have to look at. But I think a lot of people got exposed to risk and volatility that was way outside of what they did. And there were probably a lot of ETF liquidation and everything else. So how much time I got? I'll do this real quick at the close. Nobody will hear this, but those you Mad Dog and Englishmen will hear this at the very end, those of you that are here right now. But whenever you get so extended and you get caught in one of these things, the probabilities are that you'll never come back to that asset again, no matter what it does. You'll go, oh, I was there, I don't want to do that again. So the psychology around big losses is what I'm talking about, will eliminate people from being interested in the asset. And this moment that we're going through in Bitcoin will go down in history, because the last couple of times everybody talks about this 4-year cycle, there's no 4-year cycles. It's an asset that's only been around for 16 years. So you're going to take four events before and equate that to it. That's how this thing's, it's just a 4-year cycle. It goes down like this. This is a small cycle versus the old cycle. Don't buy into that. I mean, let's own an asset that every 4 years drops 80% in its value. No. I mean, if you buy it the wrong place, like if you bought over 100 in this last up cycle, you're not feeling very good down 40K. So anyway, just know that what happens a lot of times in these type of scenarios is people remember. You could go to people that got clobbered in 2008. They still remember that. It's like top of the list. So anyway, all right. Well, we're gonna call it quits here, folks. So thanks. Sorry about last night. We'll be here tomorrow night, same station, same time. So we'll look forward to seeing you then. All right, folks. Have a great night. Now for some good music.